Hey everyone, in the last section we looked at how entry eliminates profits. In this section we will look at how exit eliminates losses. I have an industry demand curve and supply curve, and just to let you all know, the demand curve pertains to the buyers and the supply curve pertains to the sellers. Anyway, the intersection is at this point A and the equilibrium price is $50. Now I'm just going to follow the numbers from the book here. The total industry output is 90,000. The farm being a price taker, it's also gonna sell at $50. I can bring in the marginal cost curve for the farm, and the farm is going to produce at the point where marginal cost is equal to marginal revenue, and from the book the number is 100. Okay, so the demand curve, just to recap, is also the marginal revenue line and also the price line. And I have the average total cost curve here, and as you can see here, the price line is intersecting the average total cost curve. So initially the price is equal to average total cost. This is a break-even situation, and profit is equal to 0. Now let's say the demand for this product is going down. When demand goes down, that means people are buying less. As a result, the demand curve will shift to the left from D1 to D2. So now we have point number 2 here, where the demand curve shifts to the left. We have another point of intersection here. This is point B, and equilibrium price is gonna be equal to $40. The farm is a price taker, and the farm's price will go down from $50 to $40. So we have price less than average total cost. Price is, the new price is $40. Nothing happened to the average total cost curve, so it's still at $50. So I can say the profit is gonna be negative or less than 0. Then we have step 3. Because the price is going down and the profit is negative, just remember the profit is negative here, the farms will exit from the industry. What happens when farms exits from the industry? When the farm exits, we have the supply curve shifting to the left from S1 to S2. Looks like a demand curve shift is followed by a supply curve shift, and we end up with our final equilibrium point, which is point C, and the price is again back to $50. So I can write here the price goes back up to $50. This happened because following the demand curve shift and profit going down, the supply curve also shifted to the left And finally, we have price equal to average total cost, and the profit is equal to 0. This is called break-even point or normal profit. Okay, so that's all for now. Thank you very much.